A Roth IRA can save you tens of thousands in taxes over your lifetime. But if you have a high income, you cannot directly contribute to this account. Now, there is a way around it, but you have to do it correctly. And in this video, I'm going to explain exactly how to do it so you can start creating tax-free wealth. Welcome back to my channel. Today we are diving into the Backdoor Roth IRA. This is a legal loophole that allows high earners to get money into Roth accounts. If you are single and you made more than $153,000 in 2023, you cannot directly contribute to the Roth IRA. You are what we call phased out. That income limits for single filers rises to $161,000 for 2024 income. Now, if you are married and you made more than $228,000 in 2023, you are phased out, and that income limit rises to $240,000 for 2024. Now, let's talk about how to get around the income limits via the backdoor method. There are 3 steps to successfully complete a backdoor Roth IRA. Step 1 is to make a non-deductible contribution to a traditional IRA. Step 2 is to convert that money from the traditional IRA to the Roth IRA. And then finally, step 3 is to file Form 8606 at tax time. Now, we're going to walk through each step because it's critical that you get these steps right. Step 1 is to make a non-deductible contribution to your traditional IRA. So you're going to need 2 accounts to complete this process. First, you're going to need that traditional IRA, which is just a regular IRA, but this account is a pre-tax account. And then, of course, you're also going to need that Roth IRA to be open and ready to go. Now, to make the contribution, for 2024, you can contribute up to $7,000 to your IRA. The limit is actually $8,000 if you are 50 or older. That extra $1,000 is what we call a catch-up contribution. Now, here's the important part. Most people would make this contribution, and then at tax time, they deduct it from their taxes because, again, we just talked about how a traditional IRA is a pre-tax account. But because we want this money to end up in a Roth account, which is an after-tax account, we are actually not going to deduct this contribution at tax time. So that is what I mean when I say we need to make a non-deductible IRA contribution for step 1. Now let's go on to step 2. So after you transfer the money into your traditional IRA, you're going to wait a few days and have the funds settle in that account. This is a fancy way of saying we need to make sure that the transfer from your bank account to your IRA is complete. And sometimes this can take a few days. But once it is settled, we do not want to leave the money there. We want to convert the money into the Roth IRA. Now, here's the trick. There are no income limits for converting funds to a Roth IRA, and this is how we get around it. Now, if you do this step correctly, there is no tax impact. A big mistake I see is people who do not complete the step correctly and they subject themselves to the pro rata rule. By the way, I am a practicing financial advisor, so I do have the benefit of seeing a lot of these common mistakes and pitfalls that people make on their way to becoming work optional. That's why I'm here and I'm making these videos. If you want to see more of these, be sure to hit the subscribe button below. Now, I'll tell you how not to make the mistake of the pro rata rule towards the end of this video. But for right now, we are going to move on to step 3. Step 3 is to file Form 8606 at tax time. Now, this is potentially done months later when you go to file your taxes, but I cannot tell you how many times people have successfully completed the first 2 steps and then they ignored this final step. Or there are times where I've reviewed tax returns and I've noticed that this did not get filled out correctly by an accountant, even when the investor told them about the steps that they took. So don't go through all the trouble of making the non-deductible contribution, converting it over to the Roth, and then forget to report your steps. Because what Form 8606 is doing is it's you telling the IRS, hey, this is the process I took for the backdoor Roth. I've already paid taxes on these funds. Because if you don't report this, you may end up paying taxes twice. Now, let's talk about one of the most important things you need to check when you do this process. I mentioned earlier that you need to be aware of the pro rata rule. If you have an empty traditional IRA, this process will be simple and smooth. But if you already have money anywhere in an IRA or a SEP IRA or a simple IRA, you will be subjected to the pro rata rule, which is not a good thing. To explain what I mean, I want to walk you through an example. So let's say you have $14,000 in your IRA and it's from a previous employer's 401k. So you left the employer and you didn't want to leave that money there in the 401k, so you went ahead and you rolled it over into an IRA. This can make sense, but it will negatively impact you for the backdoor Roth process. Because what happened was you received a tax deduction when you contributed to your 401k. So this means you have pre-tax dollars in your traditional IRA, which means when you go to convert the funds to a Roth IRA, some of that conversion will be taxable, even if you were to only convert the $7,000 that you just put into the IRA. So you have the $14,000, you say, hey, I want to do the backdoor Roth process. You add $7,000 and you're thinking, well, that's the portion that I'm converting. That is not how the IRS sees it. Remember, to do this correctly, the conversion should not have a tax impact. Now, you don't need to perfectly understand the pro rata rule. The calculations for it can be a bit complex, but you do need to avoid it. And the way that we avoid it is by having a $0 balance in your IRA, your traditional IRA, by December 31st in the year you do the conversion. So if you have money in your IRA, you actually do have a few options to empty it. Option one is that you can convert the pre-tax IRA money to your Roth IRA. So in our example, you had that $14,000 pre-tax money sitting in your IRA. You could go ahead and take that and convert that over to the Roth. This is a taxable event. That $14,000 will be added to your taxable income, meaning you will pay taxes on it. So this can make sense if it's a small amount and you're comfortable with the tax impact. But if it's not a small amount or you just don't want to pay the taxes on even a small amount, there is another option. Option two, you can transfer the IRA money into a 401k. So if you're with a new employer and you have a new 401k, you just need to make sure that that 401k accepts transfers into it, and many of them do. If you are self-employed, you might have a solo 401k or a group 401k that you can transfer into. The point here is that once the money is in a 401k, you're good to go. The 401k will not subject you to the pro rata rule. Both of these options leave you with an empty IRA. And an empty IRA, an IRA with a $0 balance, means a clean conversion. For this process, there are two important dates I want you to keep top of mind. First, you need to be sure your IRA is empty by December 31st in the year that you do the conversion. We've talked about this before, but that's the date that you will look at when reporting the balance of your IRA. So December 31st is the important date here. Now, you do have until the tax filing date, which is typically April 15th of the following year, to fund a Roth IRA. So if we're in March 2024, you can still contribute your Roth IRA contribution for 2023. Now, for the backdoor Roth process, this will make your tax filing a little different. You will actually have your conversion reported the following tax year, but will still need to report your non-deductible contribution in this tax year. Just make sure when you tell your accountant what you're trying to do here, that they are familiar with the Backdoor Roth process and that they've done it before. That is a wrap on the Backdoor Roth IRA. Thank you so much for watching. I'll catch you in the next video.